Hello everyone. Today is January 3rd, 2025. Welcome back to my channel. Today, I want to analyze the trends of the US stock market for 2025. Whether you hold US stocks or not, this could offer a fresh perspective on how the market is shaping up at the start of the new year, which has already brought some shocks. In recent days, not only has the US stock market dropped, but it has also continued a downtrend over several days. Could this be a harbinger of disaster? Today, we're going to uncover the startling truths behind this trend and explore top market analysts' insights. Last year, the Chinese stock market was like an out-of-control roller coaster, plummeting downwards, leaving investors heavy-hearted, filled with uncertainty and disappointment. In contrast, US stocks showed remarkable resilience, providing a glimmer of hope and boosting many investors' confidence that the American market could continue its strong performance. However, as 2024 ended and the new year began, US stocks took a sharp downturn, catching hopeful investors off guard and sending moods from sky high to rock bottom. This sudden shift demands a deeper investigation into what might be causing these market changes. Are there significant signals we've missed? Conventional wisdom tells us that no market rises or falls indefinitely. The US stock market has been on an upward trajectory for over a decade, and most people thought that simply buying US stocks was a no-brainer. However, according to Peter Barrison, chief global strategist at BCA Research, the US stock market could face a staggering decline of up to 30% to 32% this year. What could be the reasons? Remember the post-pandemic shopping frenzy? Stores were packed, and online orders skyrocketed. But now, as economic pressures mount, shopping enthusiasm has significantly cooled. Stores are empty, and online shopping carts are abandoned. A sharp slowdown in consumer spending is a clear indicator of market instability and personal apprehension. Everyone can feel that shopping less these days is a direct result of rising prices and stagnant or declining incomes. Economist John Smith warns that this reflects a deep consumer anxiety about the future economy and a direct hit from credit tightening. Stagnant incomes and increasingly strict credit conditions are primary factors. Turning to the job market, which once bloomed like a spring garden with abundant job opportunities easily within reach, the situation has drastically changed, resembling a sudden onset of winter. The growth in the labor market has stalled, and new job opportunities have sharply decreased. The once plentiful job choices are now scarce, and the competition for every job position has intensified. Job seekers must put in extra effort and sweat to stand out in this job-seeking battle, causing widespread unease and pressure to reassess and strategize career paths. Labor market analyst Emily Johnson states directly that the slowdown in employment is a direct result of weakened purchasing power and a clear precursor to an economic recession. Imagine, over the past decade, the stock market was like an ever-expanding balloon, continually rising to seemingly unlimited heights. But now, cracks are appearing on the surface of this balloon, which could burst at any moment. Financial analyst David Lee reminds us that the market's overvaluation is like the thin film of a balloon. A slight prick could cause massive fluctuations, making the market extremely sensitive to any negative news, which could be the needle that bursts the balloon. Let's consider the Federal Reserve. If its policy direction was once like an open roadmap, almost predictable, now that map has become blurred, and we're left guessing their next moves. This uncertainty adds fuel to an already burning fire, intensifying the market's volatility. Financial policy expert Mark Thompson highlights the dangers of this situation, warning that any abrupt decisions by the Fed could shake the market intensely, like a storm at sea, making everyone feel unstable. When it comes to investing, buying stocks might make you an apprentice, but selling them makes you a master. Let's look at investment guru Warren Buffett's recent actions. He's been selling stocks on a large scale and holding over $325 billion in cash, a historical high. Buffett is clearly signaling that he believes the current stock market is severely overvalued. His Buffett indicator, the ratio of total market value to GDP, has soared to 209%, far exceeding the historical average and even surpassing levels during the 2008 financial crisis. This suggests the market might be extremely overbought and risky. If an experienced investor like Buffett is reducing his holdings, it could be a significant warning to other investors. In summary, the turbulent start to the US stock market in 2025, coupled with in-depth analysis from economists and market experts, clearly shows a reality. Even if there isn't a further sharp decline in the stock market, the upside potential seems extraordinarily limited. The current market is like a balloon that's been inflated too much. There isn't much room to rise, but the risk of a sharp fall is substantial.